Welcome to the Millionaire Next Door podcast with Robert Curtis, CFP accredited investment fiduciary from Signature Estate and Investment Advisors. In this podcast, we help successful wealth accumulators like you looking to transition to a work optional lifestyle by helping you build strategies for growing and maintaining your wealth. Robert draws from years of experience and fiduciary responsibility and interviews guest experts to help you build reliable strategies to grow and maintain your wealth. Now, on to the show.
All right. Well, welcome to the Millionaire Next Door podcast. We just a few weeks ago passed episode 50. We're marching forward. I have a whole production team that's done such an amazing job with the podcast, Disha and Matt Holleran and their whole team. I just want to say thanks. And today we're joined by a guest, a repeat guest, Will Gibson. He's a chartered financial analyst, a senior analyst with Nasdaq Dorsey Wright. He was on episode 49, 40, and 47. He's absolutely terrific, become kind of a sidekick here, and we're both in this space. Wanted to introduce Will again, have you introduce yourself, and maybe launch into a little overview of what's going on in the markets here.
Yeah, thanks again for having me on. I really appreciate the repeat visits, appreciate the encouragement, the affirmation. I like this stuff. I love talking about this stuff with people who also like it and then also like to hear about it. You mentioned markets. To be honest, not a ton has changed since I last came on, but just to be a bit more specific, we just ended the month of May. Historically, there's this adage in the market that says sell in May and go away and then come back in November. That speaks to an old market adage that says a bulk of the market returns come outside the summer months. So not during the summer, the market generates most of its return. However, I think this year we've seen that start differently. I mean, the month of May, the S&P 500 was positive. In fact, it's been positive for the past 5 straight years in the month of May and 9 of the last 10 years. So the month of May in the past decade has been very strong. So market definitely followed through on that. The Nasdaq Composite was fantastic in the month of May. It was up nearly 9%. And then small caps were up about 5% as well in the month of May. The Dow hit 40K. So a lot of positive price action for the month of May. And volatility has been declining to multi-decade lows. I think there's some tie-ins there that we can chat about in a bit. But overall, I mean, we're having a really strong month of May and markets are just dancing around all-time highs right now.
Yeah, and yet we don't see the type of breadth we'd like, right? Hasn't it been highly concentrated, really in maybe the top 5 or 7 of the S&P 500? It's been so narrowly concentrated in these mega caps. That's just situation's been that way for a while. But any thoughts around that, or just is that what you're seeing as well?
Yeah, that it is a concern for sure. We've had some breadth readings, call it market internals, that we watch on our system. Those have declined. So in our jargon speak, like how many stocks are participating in the market rally. You're right. We have seen a decline there. The mega caps have held together, really just 4 or 5 of them, to be honest. Yep. It's even narrowed from 7. Now it's down to about 4 or 5 that have really held the major indexes together. But this is a tangent point, but it builds on this. If you look at the rolling 252-day return, so that's a way of saying about the rolling past year, the Nasdaq Composite is actually outperforming the Nasdaq 100. So the Nasdaq 100 is the mega cap, excluding financial companies, of the Nasdaq Composite. And you're actually seeing the Nasdaq Composite have better trailing performance over the past 252 days. So it depends on the universe that you're looking at. But yeah, generally speaking, it has been the bigger stocks as of late, especially this year, holding together the market. You really like to see participation come back into the story. Small caps, we would continue to want to see break out of that range. Smaller, large cap companies, so the 490th and lower at S&P 500 names, you would like to see them do a bit better. There are some diamonds in there, but generally speaking, you're right. That is a point of contention.
Yeah, we're watching this stuff all the time, as you, and just watching what moves into the surface. One of the stats I heard recently that's been a phenomenon is how well utility stocks have been doing, which I'm not really a fan of that space, to be honest, given all the capital needs. But it's been what is it? AI, artificial
Yeah,
intelligence has driven people are using power like crazy, and it's benefiting their revenues. I just thought that was so interesting.
exactly. Yeah, that's been fascinating to us too, because utilities traditionally are thought of a defensive sector in the market. If you see utilities start performing well and consumer staples start outperforming, some people will see that as a bearish sign for the broad market. People will say that I don't want to be owning more aggressive sectors. I want to take something like utilities that kicks off a high yield, they're less volatile, etc. But like you mentioned, utilities have had a unique catalyst lately. I agree. It seems to be that AI tailwind because there's been increased power demand and the infrastructure needed to run those types of program software machinery. So yeah, utility have gotten a great bid as of
Yeah.
late. I also saw in our midweek macro, the U.S. economist for Nasdaq, he was saying that a lot of utility stocks have lower valuations compared to the traditional AI companies. So people were getting essentially like cheap, like fundamentally cheap AI exposure via utility stocks so that they can play the space in a cheaper way than buying
Yeah.
high price to earnings or price to book companies that are closer in the AI space, if that makes sense.
It does make sense, yeah. But it's just such an interesting phenomenon. I had read a Chat GPT search takes 10 times more energy than a Google
Hmm.
search.
That's right.
And then I was talking to a friend of mine, he's an engineer. He was talking about some of these chips, just the power generation and the heat and the energy demands. It's so high. So it's just really interesting, some of the things we see and the changes. And yeah, any other thoughts or observations on the market before there's a certain segue or topic I'd like to maybe segue
Yeah.
to. The
Yeah.
elections coming up.
Oh yeah.
How is
Just
that?
scream that one.
It gets a lot of ink. It's a big deal, but maybe the long term. But what historically, how have markets behaved? What does that mean? Should people put a lot of stock or things? What are you seeing there
Hmm. Yeah,
historically?
that definitely seems to be the thing that people care about most right now and want to talk about the most. It feels good to talk about it. It feels good to be super concentrated around those topics right now. But the data would suggest historically that longer term, these are non-events for the most part. I mean, sure, there can be some outliers, but generally speaking, which party is in power really doesn't have a lot to say about how the market behaves, nor do even election years themselves in and of themselves drastically change how the market behaves. More often than not, markets are positive during election years.
Hmm.
To be more specific, markets have been positive about 75% of the time in election years since 1928. And we ran a study in our report looking at this. So again, from 1928 all the way through 2020, the S&P 500 has posted a positive return in an election year 75% of the time. So that's probably not a headline that would get published a ton. The average gain during an election year is about 7.5%. Now, I think I want to be clear here. There's the first half of the election year and then a back half of the election year. And we can start there. The second half of the election years are typically much stronger than the first half. The back half of election years are up about a little over 7% on average. The first half of election years, which we're still in right now, that's January to end of June, that's up just under 1%. I think there's a qualitative explanation here. Markets hate uncertainty. They don't necessarily hate outcomes. They hate uncertainty more than they hate certain outcomes. So once the market kind of sniffs out the way the election's going to go, what types of maybe policies, what types of investor behavior may be awarded or hurt going forward, then the market kind of settles in and continues on the trend that it's been on. So that's kind of just setting the stage. More often than not, markets are positive regardless of party currently in power. And then back half typically much stronger than the first half.
Yeah, that's great. That's what I've read as well. One thing I've learned over the years, having done this like 28 years, we've been through a lot of election cycles, is, and maybe this is more pronounced recently, but just to caution folks, we've seen not everyone, but some folks were sort of, this person is in power, therefore we can't have a good environment or we shouldn't go into this or that. And it's
Yeah.
not been it's really cost them a lot of money. So a lot
Hmm.
of what you and I do, and we try and make a hallmark of our process, is an unemotional, objective rules-based process, you've got to keep those kind of biases out of it, or you can really hurt yourself. And not everyone, but I've clearly seen cases where this person's in power, therefore that, or if this,
Hmm.
the world doesn't always care or see it that way, and you need to be mindful of that. So
I completely agree. Yeah, I think a general rule of thumb is that people should keep their politics as far as they can outside of their investment process and outside of their investment portfolio. A lot that goes on around election years is hearsay, it's rumor, it's conjecture, it's speculation about what might happen if this policy were to pass. And more often than not, a lot of those things don't come to fruition. So you work yourself up, you make changes in your portfolio based off anticipation of things that never materialize. And that's one of the reasons that we lean on technicals, is because like we're going to wait until the market agrees, or we're going to wait until the market actually follows through on a trend. And we're not just going to bank on somebody saying something. And we all know that there's checks and balances in the US government. It's not like the president just calls all the shots and that's that. We're not a
right.
dictatorship here. So you see divisions of power, so like the divisions of political power. So maybe a certain party controls Congress, a certain party controls Senate, a different party controls the executive branch and the president. It's much more difficult to enact this overhaul change that people are always scared of. And companies adapt. So at the end of the day,
Yeah.
markets are run by markets are made up of companies, and these companies are robust. They are brilliant groups of people running these companies, so they're not going to be too surprised or too caught off guard when certain changes come down the pipeline. So it's certainly it's not worth getting worked up over and overhaul your process for.
Yeah, those will work. Yeah, certainly these bigger companies all have very sophisticated teams and lobbyists and tax counsel and things like that. Any other
Absolutely, yeah.
market thoughts before we segue, I guess, into a story you heard at a
Yeah,
conference I wanted to delve into a little bit, but yeah.
yeah. That'll be fun. Last thing I'd say about markets is, again, summary, election years typically are positive more often than not, long-term non-events, so don't get spun up. The thing I do want to say is that it wouldn't be unsurprising to see a pickup in volatility or the markets
Yeah.
to go sideways a bit from here. If you look at average progressions during an election year. So what I mean by progression is, how do the equity benchmarks typically progress? So from January 1 to the end of December, we're coming up to the point in the year where markets tend to go sideways until you get through the geopolitical event or political event, and then they kind of cruise higher into year end. We're approaching the time where it seems to be that we could see some type of return stagnation. There's also a building group of people that are aware that volatility is very low right now. So expected volatility measured by the VIX is at multi-decade lows, which means people are expecting volatility to be very low. I mean, historically low, which could be a contrarian sign that we could see a pickup in volatility. Not to get too technical here, but if you look at the VIX futures curve, so it's expectations for volatility over the coming months, there's a spike on the futures curve at end of October, beginning of November. So that would be around the election where markets currently expect a pickup in volatility. And really now, until that point, the curve's upward sloping, which means people do expect volatility to pick up between now and then. So I would reiterate to not be surprised if you do see a pickup in volatility. That's not to say there's going to be a big leadership change, but that's one thing I would kind of end with, is that it would be pretty normal from current levels.
Yeah, that's my intuition. I mean, it's just been so low. If you look at the VIX, where
Yes.
it's pretty close to the floor. So, yeah.
Right,
And yeah, I
right.
mean, even 300-400 point moves, when something's close to 40,000, it's not a big move. But
Right.
yeah, I don't know if everyone's aware of that, but we certainly are.
Right. Yeah.
I like it. Don't they say sometimes these calm, quiet markets, sometimes they can be pretty good markets, correct? Or
Absolutely.
Yeah.
Yeah, quiet markets can be calm. I mean, I think volatility and market returns are inversely correlated. It's a fancy way of saying that. They move in opposite directions. So when markets are going up, volatility is typically going down. When volatility is going up, markets are typically going down. I may have missaid that, but I think you get the idea. That's a good thing right now. If you start to see volatility spike, you would expect the markets to come down. We haven't seen that at this point, and markets can drift on quietly higher for a long time. I think 2017, parts of 2018 were very quiet on the volatility front, and stocks did just fine.
Yeah, and this time around, the dividends probably, we're investing in dividend payers, but even on fixed income, treasuries, things like that, you can earn some really nice yields while you're going sideways and still grow your capital. That's different. So
there are some things, I think, and this would probably be the pin in the election year thoughts for me right now. There are some interesting call it proposals from both parties, either as they relate to individuals. Now, if all of these go through, I think it's quite unlikely that they all would, especially taxing capital gains at ordinary income rates, or taxing unrealized cap gains, eliminating the stepped up basis rule. Things like that, I think, can certainly pertain to individuals that may not hit a major index level. But I think individuals should be aware of some proposals that could go through, and people like yourself, I think, can walk them through some good scenarios there. But high level market talk, I think we've kind of hit the full story here.
Yeah, we just did a podcast with the guest expert talking about a 2017 tax cuts are scheduled to expire of their own design right at the beginning of 2015. That's already codified in law. So we'll see where we go. But lots changing. That's why we're watching all these details and trying to keep folks updated. Yep.
Right. Well, cool. We had another topic we wanted to mention as well, right? It was this is a completely separate topic, but I think it's related to both of our businesses, right? It's the Miami Dolphins conversation.
Yeah, you tell me about that. You explained it. Actually, I heard it on a podcast that you were at a symposium or some type of, something like that, and you got to hear someone from the Miami Dolphins, one of their top coaches, talk about his perspective. It struck a real chord with me, but why don't you tell the story real quick as you remember it, and then I can chime in why that seemed to be a great connection. It really resonated with me.
Yeah, a few weeks ago, myself and a colleague were at the Wealth Management Edge conference in Florida. It's a conglomeration of a few financial services investment industry conferences all in one together. One of the keynote speakers at the conference was the Miami Dolphins head coach. It's Mike McDaniel. If you're not a follower of the NFL, he's a character of a guy, has a lot of interesting and funny things to say. But he did the keynote session for one of the first days that we were there. For most of the time, we were thinking, like, what does this guy have to say about wealth management and finance, other than his sneaker collection and some other things that are kind of related to spending money. So for the most of the time, we're thinking, like, what's going on here? But he had a really short section of his prepared questions and answers that struck a chord with us. He said players that he works with, they work their whole lives to be able to maybe make it to the NFL. They're in Pee Wee football, they high school, hopefully play for a good college team, get scouted, make it to the NFL. They prepare their whole lives to come play in the NFL. And he said he, as a coach, he needs to respect the work and all the time that they've put in. And he has to, he owes them a service to give them the best opportunities, to give them the best system, to give them the best player process while they're on the team so that they can succeed, because their careers, we know, are pretty short. You're not playing in the NFL for 40 years. They have a finite amount of time to perform, to make money, and then maybe retire. So he saw it as a really big responsibility as a coach, that these people have worked so hard for so long to come to this point, and now it's in his hands to make sure that they succeed. So, and I think you have much more to say on this than I, but my colleague and I were thinking, well, that's a pretty neat connection to the wealth management space, because people work their whole lives or accumulate money over and over time again and entrust to somebody for their process, for their expertise, for their guidance, to help them grow, help them develop financially, so that they can be successful in hitting their investment goals and so forth. So kind of a neat connection. I'd be curious your thoughts on that more.
Yeah, it really resonated with me. So he's, what I think he was saying, he's sort of these stewards of their careers, right? They spent their
That's a
whole
better way.
life,
Yes.
their families, now, and then they have a limited career. So how can we manage that to their full potential? And these folks have a lot of choices too of where they could go, but if they're in the right setting, their career could sort of be optimized. I see a lot of parallels. There's folks that I've brought along the way, from maybe a smaller estate, 350K to now it's well over 1 million. There was folks that were sort of recruited internally, but there's other folks who come to me later once they've created this estate, and now they're looking for that stewardship, and we have an obligation to help guide that sometimes for second and third generations, and there's so much work. Someone who came, I won't give away too much, but a gentleman who's a retired cardiologist out of Texas was recently introduced to us. We met with him, started working with him. There was a whole career. You think about all that med school, all that, operating people on the table and all that. And so, that sort of legacy, he was still really concerned with growth, just growing as much as he could in a pretty large estate. And I didn't have time to get into it, but, I tried to say we're also looking at these other matters for the benefit of your family, the legacy, the estate planning. We can keep growing it, but at a certain point, if you're north of 13, $16 million, what does it matter that much if we're 0.5% better than an index versus if we carry out your wishes, So I was trying to impart that upon him, and I think he got it. Heard another discussion recently, speaking of the NFL. There's a gentleman, he's a doctor, he's a professor somewhere, and he was talking a lot just about mental capacity and all this. And he'd actually worked with the NFL. He worked with Steve Young, former quarterback for the San Francisco 49ers, and he was counseling him at some point in his career. Granted, they have a finite career, talking about, should he stay in? He's going to take some more hits, right? Hits in the head. That's what happens. There's TBIs. There's a future after these careers. What are these things as their physician? Now they're paying a lot more attention to that. And unfortunately, as we learned right in the 70s, and they didn't pay as much attention to that kind of stuff. They just got him out there and did the job, and, they weren't thinking about their long-term health. So it just struck a real chord, and I loved the way he approached that. I mean, at the pro level, I kind of wanted to say to this cardiologist, he was so into performance. So I say, it's like a pro athlete. Well, they can be like, we're into performance, we want to win this game, win this match, be at the top. Then I can maximize my career salary, my endorsement potential. Yeah, that's really important. But what if your knee gets blown out? What if you have a TBI? These are other factors that one would want to consider. So we're trying to manage to and through that. But the Dolphins coach, I really liked his approach as a steward to that. You even look at college football now. I've heard some great discussions about people used to just get recruited into a program and they were sort of stuck with that program. Now there's an open portal and they can go to different places. So you want to be a good steward of their careers, of their lives, and their potentials, but respect all that work that went into it, but really looking out for them and not just the numbers and the latest headline. But that's it is the role we embrace, and that's what connected with me. So I definitely resonated with his message. So
there's that also reminded me. I was listening to a podcast the other night. Some of the most unconventional financial advice I've seen people give, but I think it's some of the most helpful is one, asking people or reminding people, like, why are you investing? Why'd you start investing in the first place? And then to follow up, almost a rhetorical question, it's, you should be spending your money. If you can grow a portfolio to 10, 15, $20 million, that's great, but you're not taking it with you. So sometimes the answer is like, you don't need to be trying to double the S&P 500 at 60 years old. Maybe enjoy some of your money. You can de-risk. The risk of getting hurt, your portfolio getting hurt, is pretty high when you're investing that aggressively. So again, why are you investing? For what reasons? Enjoy your money. It's a tool at the end of the day. It's not just about watching it go up in account value.
Yeah, and in some cases you've already won the game.
You've won the game. You've won the game.
Yeah, and so now deploying or looking out for other things or maximizing your longevity or your enjoyment or gifting, we can have those conversations. And then I think, quite honestly, just for folks who are listening, there's certain folks that do sort of look at us from that performance standpoint, and there's others who engage on a deeper level. We're probably better suited towards those at the deeper level. We're here to actually get them to their goals and think about how they're what their legacy stands for in these deeper, or avoid maybe blind spots they wouldn't see. That's of more value. We're still trying to grow the assets, believe me, because inflation is a real thing and stuff costs a whole lot more in the future.
Sure.
But those are all important, and I just really like that approach. And that's kind of what we're looking at too, not just can we eke out more victories for the Dolphins, and increase the enterprise value, but also what's going to be the legacy of those athletes. And they're going to put themselves on the line for that team and their teammates. But how, they want that support team around them to be watching other things, people on the sidelines and with perspective to help guide that career. So that was just a cool, you probably had no idea I'd connect with that, but I thought it was great. So
I didn't, but I'm glad you brought it up.
Yeah. Cool. Any closing parting shots? Anything else? Just wanted to touch base with folks and thank you for being here. But yeah, any other thoughts as we close out here?
Yeah, no other thoughts. I've exhausted my words probably. Thanks again for having me on. I enjoyed the conversation.
Great. Well, we really appreciate it. So I'm hoping to do this again too, because you've always got great thoughts. We've just seen a lot of trends continue in the market. So we feel like we're repeating ourselves on some themes, but things are always changing. And right when sometimes you never know what's changing under the surface, but we're watching those things closely. So really, really appreciate you being here. Thanks so much, Will.
Yeah.
Yep.
Thank you.
And to our listeners, thanks for being here. Please, if you enjoy this, like it, share it. If it can be of help to anyone, we'd appreciate it. Thanks for listening. Thanks to our team that produces this, and make it a great day, everyone.
Thank you for listening to the Millionaire Next Door podcast. Click the subscribe button below to be notified when new episodes become available.
The information covered and posted represents the views and opinions of the guest and does not necessarily represent the views or opinions of Signature Estate and Investment Advisors. Signature Estate and Investment Advisors, LLC, SEIA, is an SEC registered investment advisor. However, such registration does not imply a certain level of skill or training, and no inference to the contrary should be made. Securities offered through Signature Estate Securities LLC, member FINRA SIPC. Investment advisory services offered through SEIA LLC, 2121 Avenue of the Stars, Suite 1600, Los Angeles, California, 90067. Telephone number 310-712-2323.